Hey traders, this is part 2 of the supply and demand video series. It is about location. How do I find those levels? How do I find the location to trade? Where are located in the chart? Are they statistically sound or statistically probable for me to take a trade from there? Well, stick to the end of the video because I'm going to give you the one and only auditing answer that makes me have more confidence and have the odds on my side at the time I take these trades. So let's jump right in. Technique number 1 is buying and selling tails. Everyone that has had some screen time can recognize them. And the idea is pretty simple. Let's do it with an example. If you have a lot of buyers and you have a series of buyers trying to drive prices up, and then suddenly it face a wall of sellers and the sellers become stronger, now prices start to reverse. Value is perceived lower. All these buyers are now probably underwater or bailing out their positions, creating more momentum to the other side. So this is an example of a selling tail. So selling tail, prices go up, suddenly they stop, they find a wall of sellers, and then prices collapse to the other side. This is another example of a selling tail, although some of you will debate me that this is not a selling tail because you have a bunch of candles here of 30 minutes, but if you go to a higher time frame, you will spot it very easily. Okay, and then here it is, a nice selling tail, right? And the other way is in the contrary, the buying tail is this one. Bunch of sellers were driving prices down. They found a wall of buyers, very high volume, and they pushed prices up. So that is the first technique that I use to find good locations where buying or selling tails are. And I found here, I cherry picked these examples for you to see how this buying and selling tail works. For instance, this one, prices came back here, pushed prices down. Second retest, not an opportunity for me. Second retest is a lot less probable, but still worked. This one, same thing. Prices came here and reversed. Another retest here, and at the end of the day, it ended up going lower. Okay, so one of the things that I mark off in the chart is buying and selling tails. Number 2, you have extreme of the range. Extreme of the range. If you have a range of few days of trading, I like to watch the 30 minutes. You can go to the daily, but I think the 30 minutes, I have found an edge on the 30 minutes. It has 13 candles for the day, and I think is a lot better than the 1 hour. Remember, the market is fractal. Whatever you see happening on the daily, you can see it happening on the 30 minute, 15, and so on. You have to find a time frame that is suited to your trading style or your trading mindset or psychology, if you will. Now, one thing that I need to say, and it's important, everything I'm talking about is about Tom Alexander in this book. I'll show it in the video. In the last video, I show it. So it's important. If you want to go more in depth, go and buy this book. All right. Extreme of the range is the same idea. Accumulation here. Or there are sellers or buyers here. If prices break to one of the side, those sellers that were selling in this range now are underwater. Next time prices come here, they tend to try to bail out positions successfully or not. We don't know, but they could try to put some pressure into prices in certain direction. And this is an example. This is the top of the range. It came here and then it came back here. Now, as said, it is a key reference area. Is the stop shouldn't be here. So everything is contextual. What if at this level I don't have the dollar and I use not only one thing, I use few things to enhance my trading, and stick till the end of the video because at the end I have an enhancing technique that I use exclusively for location. But in my day trading, this area is huge. It's 48 to 06 is 42 points. Who is going to take an area of 42 points? Not me, right? It's too large. So what I like to do is just narrow this and see when the conditions are met. For instance, the dollar, internals, etc., etc. So what happens if the dollar is aligned when prices are here? Here is where I take the trade. Even though briefly went below the area, still valid. right? Unless value is built up below here, I discard the area. But if prices come here and suddenly reject reject prices to the upside, I still think that this area is valid. So that's why it's very important to clarify that it's a key reference area. It's not that the stop has to be here. Okay, just to be clear. So, and you need to practice this in order to get more experience and try to understand. For me, for instance, when I'm trading at a range extreme, I like to take this trade. When I take the range extreme, I like to take this one, right? We broke here, gapped up, so I get long here. Easier said than done. I understand that, but I'm talking here theory, right? On the practice, the market is very messy and you have to deal with your own psychology, and that's another topic, right? But I like to take this one. We broke from the range, we came back, tested, and continued. This type of trade for me is second retest. Although it worked, like here it worked partially, here also worked, and then we started to build value above until we now rejected this to the downside. So this is one example of the range extreme. Remember, I have cherry picked this area so you see the concept and you can go ahead and play with the chart with other assets. You can do this on the NQ, you can do this on the RTY. It works the same. Okay. Again, range, came back, retest, boom. Now, like I said, in the other one, it did work. In the other one, it did work the second retest, not in this one. Sorry, not in this one here. So you get my idea. That's number 2. Number 3, launching points. Launching points are very important because it's where, as the example of the buying and selling tail, this is a continuation of overwhelmingly higher volume to one directional, giving you conviction to the direction. One of the conditions that we call here, that we name here, is directional conviction, right? You have a launch point from there, prices flew suddenly and never came back, right? And the important condition here is if flew, it started from this area, launching point, right? And we build value in a different level. For instance, here, you see that? Because if we go ahead and we go up and then we suddenly come back, it's hard, right? My personal condition is, all right, we built value already. Now we have this few days of trading. This is like 3 days of trading. We build value here. We continue to build value here. And then next time it comes, boom, come here. A bunch of sellers that were present here perceive value above this level. They come into the market very aggressively and they push prices up. Remember, for me, and this is a Franco thing, you don't have to do this. For me, is the first retest. After the first retest, probability and odds go down. Why? I've talked about the glass of water analogy. Every time you have a sip, there's less water. Picture the amount of orders that are here. They are a finite amount. They are being spent, right? And after this launching point. Again, you can notice how the third time still buyers are present here, but now in a less powerful form and slower momentum. Okay, prices go up, retrace, and go up slowly, and at the end of the day, they had the strength and they drove prices up. That's number 3, launching points. Number 4 is high volume node of horizontal volume profile. If you haven't seen my video, please go check it out and you'll learn the number 4. Now, what can we do to increase the probability of these areas to be more effective? We look for confluence. So what is the other enhancer that I talk about? The other enhancer I talk about is confluence. Confluence is when one or more of these conditions are met. If I have a high volume node and I have a launching point. By the way, I didn't talk about how the gaps are by definition a launching point. Why? Even though we did have very low volume, that itself explained that there were no opposite order or opposite force to move prices to a certain level. So this is the example of the gap, right? So the gap is present here. That means that there were no sellers here. There were no sellers to push prices down or to content prices. This is itself a launching point. And then you have confluence with the high volume node, meaning you have a high volume node. I'll give you the link down below for the video for the high volume node and volume profile. So you have the high volume node and you have the launching point. Both are in the same exact area. This is the launching point. We build value here for a few hours, 3-4 hours. Remember that that's a condition that has to be met. We need to build value above. We need to build value in another area, because if we don't build value, we don't know where value is. But if value is actually above, we know that next time the prices come here, all these aggressive buyers are going to show up and push prices up. So that's how I enhance, that's how I increase my odds to have a higher probability when I take these type of areas. So please, if you like this video, like it and consider subscribing to the channel and share to other people so we can reach more traders. Thank you. I'll see you in another video.